In September 2019, the financial system nearly broke down overnight. Interest rates in one of the safest markets in the world suddenly spiked from 2% to over 10%. The Federal Reserve had to step in and inject billions just to keep Wall Street alive. This was the 2019 Repo Crisis, and most people never even heard about it. So, what happened? Why did this obscure market almost trigger a financial panic? And what does it tell us about the fragility of modern finance? Repo, or repurchase agreements, are short-term loans. A bank, hedge fund, or dealer borrows cash today, pledges treasuries as collateral, and agrees to buy them back tomorrow. Why it matters? This market is the plumbing of global finance. It provides the liquidity banks, dealers, and funds need to function daily. Without repo, trading freezes, funding dries up, and the system suffocates. For years, repo rates tracked closely with the federal funds rate, staying around 2%. The market was considered boring, reliable, almost mechanical. But beneath the surface, stress was building. Corporations, Treasury issuance, and bank regulations were slowly tightening liquidity. First, the U.S. government was running larger and larger budget deficits. To finance those deficits, the Treasury had to issue a flood of new bonds. That meant the market was suddenly full of treasuries that needed to be financed in repo, increasing demand for cash. Second, after the 2008 financial crisis, regulators forced banks to hold far more reserves and maintain stricter balance sheet ratios. That made the banking system safer overall, but it also meant that big banks were much less willing to lend out their spare cash in repo, even when the system desperately needed it. And third, mid-September is tax season for U.S. corporations. Companies across the country pulled huge amounts of money out of the financial system to make quarterly tax payments. That cash was gone from money markets just when it was needed most. Repo rates, usually around 2%, suddenly spiked to 10% overnight. That's like your mortgage rate jumping from 3% to 15% in 24 hours. Why? Because there simply wasn't enough cash. Corporations had just pulled billions to pay quarterly taxes, while the U.S. Treasury settled $78 billion of new debt. Meanwhile, big banks sitting on reserves weren't lending. They were constrained by post-crisis liquidity rules. The Fed steps in. The Federal Reserve realized the system couldn't function. If repo failed, every other market, from treasuries to stocks, was at risk. The Fed injected $53 billion overnight and then kept pumping cash, eventually supplying hundreds of billions through repo operations. It was the first major liquidity injection since the 2008 crisis. The 2019 repo crisis exposed how fragile the system had become. Even with plenty of treasuries, there wasn't enough cash flowing. It showed that regulations after 2008 made banks safer individually, but less willing to lend collectively. And it was a warning shot. When COVID hit in March of 2020, the Fed had to step in again with unlimited liquidity, building on lessons from repo. Conclusion: the repo market is invisible to most people, but it's the lifeblood of finance. In 2019, a short hiccup almost caused a heart attack. Without the Fed's intervention, Wall Street, and maybe the global economy, would have faced a serious shock. So next time you hear about repos in the news, remember, they're not just obscure jargon. They're the system's oxygen supply. And when repo fails, the entire financial world can't breathe. If you found this video helpful, give it a thumbs up, share it with your friends, and let us know in the comments what other financial topics you'd like us to cover.